Okay, let's get started. Hello, everyone. Welcome to our webinar series on capital market development, China and Asia. And today we're very happy to have Professor Emanuele COLONNELLI from Chicago booth to tell us about a field experiment in China on investing with the government. And we're also very happy to have Professor Sabrina T from NYU Stern to discuss the paper. So without further ado, Emanuele, the floor is yours and you have 25 minutes, please.
Perfect. Thank you so much, Michael, and Vera and everybody for organizing. I hope you can hear me well. And huge thanks to Sabrina, who I've been in discussions that are 25 minutes long. I know how painful they are. And so extremely grateful and looking forward to it. Also, this is joint work, of course, with Ernest Liew at Princeton and Bolly, who probably many of you know at Tsinghua. I should say usually it's me talking to Bo when it's midnight in Beijing for hours and hours in her office. Now I'm trying to reciprocate a little bit, but thanks a lot for all the work. So I'm gonna get started right away with a very simple motivation, in the sense that I don't think I need to convince this audience that, of course, the government plays a pretty massive role in the economy. This is true from the perspective of entrepreneurs, firms, investors, and so on and so forth. In this paper, we're gonna focus in particular on the crucial job the governments have in ensuring the efficient allocation of capital in the economy. And on this front, the typical massive work that we have in mind is one in which we look at the government from two perspectives. There is the political perspective, which will tell us that government is corrupt, there is a lot of favoritism, inefficiency, and so they misallocate resources. There is the other development views that would say, wait a second, actually the government might not be perhaps the best implementator in certain contexts, whatever, but they do a fantastic job at trying to address externalities. And so they allow for capital to go to the areas, to the sectors where capital would not otherwise go, but it's actually socially optimal to do so. And so this is an issue that has obvious implications. We're going to look at the venture capital and private equity context. This is an issue that obviously is important when it comes to caring about high growth firms and in particular innovation. It's true in China, which is going to be our focus, but it's true in many, many other contexts around the world. And in the context we study of venture capital VC and private equity PE, so I'm going to often talk about VCP, we often think as potentially getting money from the government being maybe good from the private perspective, because it allows me, for example, to have maybe easier access to opening doors, to having more information, to have a signal of approval of some sort. On the other hand, of course, it could be negative because having to deal with the government might introduce some extra distortions that might be driven by political interference and a lot more. We're going to try to talk about this in a lot more depth. The point that we have in this paper is a very simple point. And actually, that's going to be what this talk is about. I'm going to try to make one very simple point, which is the literature tends to focus often on the consequences of government involvement, often talking again about whether it's misallocation or not. We're going to take a step back and say, before we discuss the impact and the consequences of government involvement, we might want to think carefully about the demand for government participation. Meaning, if ultimately whoever decides on how the resources are allocated on the real economy are firms that get money from the government. If these firms differ in the extent to which they are happy or unhappy to receive money from the government, that will have implications in equilibrium, which we want to understand. And so I'm going to be a lot more clear on what I mean, but this trying to make this very simple point of, let's look first at the demand for government. The government might have consequences, and their effect might be driven by the fact that they might not be able to attract the best players in the private sector, perhaps because of all this extra baggage that they bring with them. So is $1 of government capital equal to any $1 or not? Very ugly, but useful slide to fix ideas. I often think everybody knows the VCP context. It's not necessarily the case, or at least it was also not the case for me before joining Booth, perhaps in details. And so I want you to take the perspective that this is a very simple two-sided market. Think of it this way, at least. It's not very simple, it's very nuanced, but I want you to think about it as a two-sided market where we have investors on the one side. Here we can have government investors. They could be a state-owned enterprise. It could be instead a private investor. It could be a pension fund, a high net worth individuals. These are the investors who pool capital and they put it together into funds that are then managed by the VCP firms, the general partners, the GPs, what I'm going to refer to. They can also have some government ownership, like any firm in China, but they are the ones who are going to receive the capital from the government or from other private sources, and they're ultimately going to invest it in firms. So we're going to only focus here on the matching on these two-sided markets between investors, the LPs, the limited partners. They are limited because they are supposed to only put the money and be passive investors, and so they don't have full liability, and the GPs, the firms who actually get the money from the government and then invest it. So this is what I want you to think about. I'm going to often talk about LPs and GPs. LPs are the investors, GPs are going to be the firms that receive the money. We're going to get back to this point. Importantly here, this is a two-sided matching market that is full of frictions. It's not easy to find an LP if you are a VC firm trying to look for funding. It's not necessarily easy to find the right GPs if you're an investor who wants to invest capital in an optimal way. So this is a matching market where intermediators tend to play an important role. That could be informal networks, or it could be like our partner in this study that we will see in the market. What we're trying to do, in this context is that we're going to try to ask, as I mentioned, the basic question of, let's take all the GPs here, all these private VC PE firms, and we're going to ask whether everything else equal, they'd rather get, let's say, $100 million from the government or from a private entity. That's a simple question we ask. That is, we're going to try to estimate the demand, the preferences for government capital versus, of course, other private sources. Of course, this is difficult for an obvious reason, which is one, of course, is like point 2 here, which is it's not always easy to find data in this context in particular to be able to look at this type of matching. But more importantly, the friction in doing so is point 1, which is often we only have observational data. And by only having observational data, often we're not going to be able to uncover preferences. Why? Because we observe outcomes of the matching. This means that the matches itself might reflect, for example, the fact that, like, let's say Tsinghua is matching to the government, is getting money from the government, but that's perhaps because Tsinghua is a very big VCP firm and only the government will have enough money to fund Tsinghua. And so we see this matching. It doesn't mean that Tsinghua would like to necessarily have money from the government, but it could be reflective of something else. Of course, being the matching, we also don't see many other things. We don't see unsuccessful fundraising attempts by the GPs. We don't see the fact that perhaps people are not able to meet other type of partners and so on and so forth. And so we're going to try to go beyond this challenge in a very sort of, like, I think in this context, creative way, which is ultimately our innovation in this paper. So what we do in this paper is the following. We're going to combine somewhat new, at least, but rich, more importantly, microdata. A lot of this is something you're familiar with. This is going to be administrative data on China VCP. This comes from Zero to IPO, that is our main partner on this study. And the info here is the usual sort of VCP type of info, which is, it's pretty good in telling you which GPs match with which LPs and vice versa. It's not going to be great or perfect when it comes to returns and like the actual outcomes of the investment. We're going to try to talk about that later. More importantly, it's also new data because we're going to be able to do a big survey of both investors and VCP firms. And in particular, like, part of our surveys are going to be part of an experiment. So it is like the main innovation and main part of the paper, which is we're going to survey about 1,000 between GPs and LPs of these sort of like VCP firms and investors. And we're going to try to estimate their preferences in this type of experimental survey in which we ask, for example, GPs to rate, to give a ranking of potential partners, potential LPs that they would like to get money from. And we're going to do this in a non-deceptive, incentivized, real stake way. And this, by the way, an experiment that we conducted in December, more or less 2019 in Q4. So this was pre-COVID. That's, of course, an important statement to make in this context. And then at the end of the paper, we're also going to try to spend some time to talk about a simple model we're going to use to make sense of the facts. But the main finding on the paper will be that everything else equal, we find that the average GP, the average VCP firm, seem to not want to get money from the government, everything else equal. That is, it seems like this preference from government investors seem to come primarily from private GPs, not from government-owned entities. And in particular, it comes from the highest performing ones. Of course, what this means is that this could have many implications. This means that perhaps any outcomes we might observe about the government, perhaps misallocating money, how we want to state it, it could be driven by the fact that they are not able to attract the best fund managers in the first place. And I'm going to go back to a lot of this in details. I skipped intentionally a lot of the contribution on China to not offend anybody in the audience, but of course we're working on it. I think the main point here is that I think this is the first experimental estimate of demand for government participation, and it's a pretty large survey that allows us to unpack a little bit the black box of VCP and the funding of innovation in China, which is of course of primary importance. I skip the context relatively quickly, just a couple of points. Often when we think of VC and PE, it's two different things in the US. In China, these distinctions tend to be quite blurry. Think of it as early stage growth equity type of deals in the market. Second thing is that this is a massive industry in China. We're talking about the second largest industry after the US in the world for the funding of high growth firms and innovation. And this is a context where the government, of course, play a massive role, but it's not the only sort of like type of investor that you have in the market. It's about split 50-50 between the government and private entities. These are the type of LPs that we observe. It's a pretty developed market, of course, as you probably all know. What is the role of the government? Here, we're going to focus on the role of the government as an investor. Of course, the government plays many other roles, but like as an investor, we're thinking about SOEs, local government, central government agencies that might supervise, own a large share of these LPs, so the investors. So we might have like certain entities that have a known VC private equity entity where they try to fund PE fund managers precisely for like directly for certain purposes, or it might be that they do it in a very indirect way. For today's presentation, we're not going to have too much time to discuss all the nuances. But in this context, what I want you to focus on is that we are trying to understand the demand for this government capital, for these government LPs. We're going to focus on the private perspective. That is, we're going to focus on, let's say, Michael or Bo. They are GPs in the market, and they're trying to get money from some of the investors. From their perspective, the government can have lots of pros. They can bring in their political connections. They can be a stamp of approval that you know how to get the doors being open, or there are many other stories. Perhaps some of them have to do with some story of corruption, some of them not. It's a very big entity that could bring a lot of pros to you. It can bring a lot of cons. The typical cons are about investment restrictions that the government introduces, extra exposure to policy uncertainty. There might be a misalignment of incentives, because the government sometimes might have incentives that are different from just pure profit maximization, and so on and so forth. So this is the perspective you want to take when we're going to look at whether you want government or non-government money, everything else equal. These are the trade-offs that we're trying to juggle. The data we use, as I mentioned, is this new survey that we conducted with Zero to IPO. Just to give you a sense, we conducted a survey of about 700 GPs and 300 LPs. All the respondents managed about $1 trillion in the last couple of years. We're talking about big investors that responded to our survey and participated, and they responded with a very high response rate. 43%, 42%, which is our response rate. It's incredibly high for this context. I'm putting here some numbers, but notice that the only comparable one, the Gompers et al., for example, it's based on a survey of 100 former MBAs and alumni of the authors of the paper. So like 40% in this context, we think it's very high, will give credibility to some of the findings we have. And again, we can talk about sample selection and so on later as well. Other sources I mentioned is Zero to IPO. I have to go very quickly for the time here, but all the analysis I show will be focused on what they define as active GPs and LPs. This is about like a few thousand GPs and a few thousand LPs that have made investment that Zero to IPO captured, and for which quality of the data was considered high by Zero to IPO. What this means is that this is positively selected as a sample. In the VCP setting, it's hardly the case that you can observe the universe, and we're very honest about that, but we do think we capture at least more or less the cream of the crop of a very big market that manages quite a lot of the funds in China. As I mentioned, the data on returns is what, of course, is going to be like not perfect, mostly because it's not that it's not real, it's that it's not always available for every type of deal, every type of GPs. So keep that in mind when we look at returns or anything like that. But we are able to look at the matching because we can see funds that are created where the LPs put the money in as investors, and the GPs manage to invest in firms. So we can see in this way the matches between one GP and one or more LPs. And so we can see who matches with whom, which is very important in our context. Other data sources that we use are sources of data that many in this audience have used already, such as data on government ownership and in general on the ownership network of every firm in the economy. So in our context, we're going to define as government-owned any entity, GP or LP or any other firm that has at least one shareholder who's a government entity. It's not going to be a consequential decision for our analysis. It's pretty robust to like measuring it in a lot of different ways, such as having at least 50% of government ownership, at least 20%, and so on and so forth. And also we did another survey. This was done actually like a month ago, more or less, which also means take it with a grain of salt in the sense of like, we know the word of VCP changed and the word in general changed a lot between 2019 and 2021, but it's a survey in which we actually literally asked a bunch of our respondents what they think about directly, not in an experiential way, what they think about having the government as an investor. What are the pros? What are the cons? Something that is trying to open this black box, which we know very little about. Now, let me establish just a couple of facts before I go to the design and the results, all very quickly. But the basic facts I want to show is, first, descriptively, you can see, you can probably like just focus on what I say in this case, but it's like simply that the LPs that are government-owned versus not are very different between each other. The government investors tend to focus on inland regions more so than big cities and coastal regions. They tend to focus on manufacturing more so than high-tech sectors and so on and so forth. They are very different. That's important because of the design of the experiment. They are also a lot bigger. You can see here, these are government LPs. This is active, it means the main sample. This is the sample of the respondents. Focus on the active. The government LPs are a lot bigger. They, on average, invested about like 100 million on a given fund, while the non-government would have invested about 18 million. This is like based on data for the past like 5 years. So these are bigger investors, as I mentioned before. These are the deep-pocketed investors. Typically, what we always observe from this simple sort of like table is that government-owned GPs tend to be instead sort of like performing at the worse, they have a worse performance, as you can see in terms of IRR. So these are a couple of facts. Government LPs are bigger, government GPs tend to perform worse. We can see, like, we can talk about sample selection later, but it's not a big issue when it comes to our respondent sample. The two facts I wanted to establish is that one is, this is something that other papers have shown, but we established it also in the data, which is government-owned GPs, meaning the fund managers that are also owned by the government, they tend to perform worse. This is based on like IRR for the set of these for which this is available, and of this measure comprehensive return. These are confidential measures of 0 to IPO that they use to conduct the ranking. The whole point here, don't focus on too much on the magnitude, is that it's pretty robust, the pattern of government-owned GPs performing worse when it comes to actual investment returns. The second is that this, I think, is a novel fact, perhaps not so super surprising, but what we find is that this is a likelihood ratio set of indexes where we see that government-owned GPs tend to be significantly more likely. That's a ratio larger than 1, which means it's significantly more likely that they match with government LPs compared to other investors. In practice, what this means is that everything should be equal to 1, all these cells, if the matching was random. If any GP, depending on whether they were government or not, they would match with a government investor or non-government investor. Instead, what we see is that we see clustering. We see government-owned GPs getting money from government-owned LPs, and this pattern is very strong. So we have two facts. We have assortative matching, government-owned entities, they get money from the government, from government capital, from government investors, and they perform worse. The naive way of looking at this will be, oh, the government as an LP is misallocating resources. They are giving money to the government-owned GPs, and these GPs are also performing worse. They have much lower returns. And we could stop here and say something about like the government not being the best investor and perhaps having policy consequences such as maybe it should not be the government giving money to this type of fund managers because they only give money to the fund managers and invest with worse returns. Or we can go one step further, which is what we try to do here and say, okay, one other story in which this work could happen is one in which the government LPs might introduce some extra distortions, for example, that might make it such that the non-government GPs, which are the good GPs that perform at a higher level, might not want to get money from the government if they can, for example, or at least the story might play a role together with the rest of the stories. And so that's what we do with experimental design. We try to like estimate the demand for government participation, for government capital, precisely motivated by these facts that we think could be a bit more nuanced than the way we typically interpret them. And so, as I mentioned before, I'll have to skip quickly, unfortunately, to try to get to the result, but the experiment is motivated by a large methodology that you are probably familiar with, which is the audit resume studies. Think of the Bertrand de Moulay-Nathan study in which you want to estimate discrimination for example, like a Black person versus a white person. And what they did was to send resumes, to send CVs to potential employers randomly. They created these CVs by making them look like they were real, but they changed the name to be a Black sounding name versus a white sounding name. And what they found is that there was discrimination because people were ranking lower, that is, they were not calling back the resumes that were with a indicative of a Black person, everything else equal. We are motivated by that type of analysis and by the refinement of this type of analysis, for example, this Kessler et al. AER, and we're going to apply this to the context of VCP. In particular, what we do is that in this context, what is key is to have a partner that can provide valuable and credible incentives. So we're going to collaborate with Zero to IPO that does play an important role of the matchmaker in this market as well, to the extent that they can, in which they try to make introductions, in which they try to organize events where GPs and LPs try to meet. We're going to create this new sort of like matching service that they offer, in which they ask GPs, we estimate preference on both sides, but focus on the GPs, meaning we want to know whether the GPs want to get government money or non-government money. So they ask GPs to please rank the following potential profiles of investment partners. That is, this is Michael, these are the characteristics of Michael. This is Bo, these are the characteristics of Bo. Give me a ranking for all of this, give me a rating, and based on the rating, what I will do is that I will match you by making warm introduction to the real potential investors. And the reason why the GPs would do it and they would respond truthfully is because, of course, they are promised to be actually made an introduction based on the responses they give. They have no incentive to lie. And importantly, this is done by a partner that they trust, and that is sort of like providing a valuable incentive. Not only that, this is a survey that is costly to take. It takes about 45 minutes. The fact that we have a high response rate, and these are like high-level managers of like billion-dollar funds, suggests that perhaps what we're getting is some very good and unbiased measure of preferences that they have for different potential partners. How do we do this, by the way? What we do is that, let's say, like again, like Michael is a GP. I ask Michael to rate potential pieces of text. Pieces of text that look like an email. It could look like an email that I make to introduce Michael to a potential investor. So I will tell Michael, please meet Tsinghua. Tsinghua is, for example, I'll show you an example here. Tsinghua is an investment institution formally established in 2002. They are headquartered in Beijing. They focus on these industries and so on and so forth. They have a link to the government because in this case, for example, they were approved and overseen by the provincial committee of the Beijing government and so on and so forth. So we asked Michael to rate a bunch of these potential profiles. These are pieces of text that you could put in an email. This is very realistic in this context in which people have limited time and this is sort of like what they see. And the way we do it is that these are pieces of text that we find in the actual real platform of Zero to IPO where LPs and GPs are described. So what we did, and again, I'm skipping over a lot of details. I'm happy to chat more later. What we did was to basically go over all these real profiles of LPs, of investors. Then we understood what the pieces of information in these profiles were. We attached probabilities to the type of pieces of information that usually happen, that usually appeared. So for example, often you do see the government ownership or the government relationship of a given LP. Often you do see in which industries they're interested in, how much capital they're willing to invest and so on and so forth. And so we basically got all these pieces of information to create variables, potential pieces of text that could enter into the description of an investment partner. We scrambled all this data together to randomly create the equivalent of what is a CV that looks realistic. It's not, it's hypothetical, but that looks realistic and had all the components that you can sort of like estimate preferences on. The interesting part here is that you can randomize them. All the components will be independent of each other, which means we are now able to estimate preferences for certain characteristics, holding everything else fixed, which is not possible in the observational data where the government LPs will always be bigger than non-government LPs and so on and so forth. And again, we're happy to discuss later, but hopefully this idea will give you a sense. We have many ways. This is just one case. We have many ways to indicate the government relationship. We have many cases to indicate the industry and so on and so forth. We have like about like 100,000 profiles that we created that are all different from each other, and they can all be mapped into a regression of how much does Michael like this profile versus a profile that looks the same, but doesn't say anything about the government relationship. Perhaps say something about like the fact that the investment institution is a private entity. And this difference in the rating by Michael will tell us a preference for certain characteristics. Government, but could also be for other characteristics that we randomize. This is in general a robust way to estimate preferences, not just over the government preference, but over many, many other aspects of a potential investment partner. Okay? And then we ask in particular on the rating to rate on a scale of 0 to 10 this hypothetical profile. The respondents know they're hypothetical, but they understand that the rating will be used to feed the machine learning algorithm that will select real actual investment partners that then they will match to. I understand they have like 3 minutes, so I will try to like wrap it up. And we also measure not just partner rating, we also measure the expected probability that you think the other party would want to match with you, the likelihood of a match. This is important when it comes to the model, which I'm getting a feeling I'm not going to be able to talk about, but it's very important. It's a unique part of this experiment, which allowed us to estimate preferences and expected preferences on the other side. So what are the results? The results is that, first of all, the regression is very simple. Everything is random, so I can estimate preferences in a very unbiased way, and I can estimate preferences for the various GPs, putting also GP fixed effects, because each GP looks at least at 20 different profiles. What we find, as I mentioned before, is that the top coefficient, which is also what we pre-register. So we said ex ante, this is the coefficient we're going to look at, which we call government ties. This is like one of the many measures in which we disclose that the investor is linked to the government. We find that the average GP dislike government capital, everything else equal. Everything else actually that you see when it's significant, seems to suggest that these people are responding truthfully, because it's all in line with what you would expect. They like more money. They like sort of like whether they like investors that have more like they're more deep pocketed and so on and so forth. Interestingly, when it comes to the mechanism, just to wrap it up, why is that? I guess that's the obvious next question. What we see is that we are thinking that one big story, of course, is that there is political interference that the government might introduce as an investor, and GPs do not like that. That's perhaps something that like a private investor who wants to make money is not going to be happy about. And we think we hypothesize that this is going to be more likely to be the case for non-government entities, from GPs that have no link to the government. And in fact, we find that the old negative effect, the old negative preference, this preference for government capital comes from these non-government entities. The government-owned GPs do not prefer government investors. They're just indifferent to it. But interesting, this is also the only difference we observe between the two. Everything else, it doesn't matter. But government-owned versus private GPs tend to have a strong difference when it comes to preference for government. And we can do a lot more tests. This is telling us that it's especially the top performing GPs that do not like government capital. And that's, of course, going to also have implications. We also did a survey later, as I mentioned, of mechanism, trying to ask people directly. This was after the experiment, so we can ask, and of course, there are sample selection and disclosure issues, but we asked the main pros and cons. And when you look at the cons, panel B, you can see that a lot of the GPs will tell you that investment interference is the main issue. That is, the government, after they give you the money, they are not passive investors, as you would expect from a typical LP, but they tend to sort of like try to target certain firms, certain sectors. They will try to introduce a little bit more nuances into the process that you would not want. There are other aspects that are interesting. This is a survey that to me was eye-opening for many regards, also on the pros, but the one that stands out seems to be this investment interference. So just and we also survey the other side. The interesting part is that on the investor side, the LPs, what they do like is to give money to GPs that have a government investor on their list already. So the reason why we ask this also, like we do this survey of LPs, is that we see preferences now on both sides. And by having preferences on both sides, we're going to be able to quantify sort of like the distributional consequences of government participation. Why? Because of course, we showed you something which is very basic. On average, we don't see GPs wanting government money. But of course, like to understand whether a simple policy experiment such as, okay, then let's do the following. Let's tell the government to just sort of like not give money to the government-owned entities because they perform poorly. Let's just have them give money to the government, to the private, well-performing GPs. This is going to have equilibrium implications because there's going to be substitution among the other government-owned GPs. It's going to be because perhaps the non-government-owned GPs do not actually get any benefit from getting money from the government, and so on and so forth. Many reasons why a model is important. So we build a model of two-sided search and matching, which leverages both the administrative data, that is the excessive matching, the matches, and experimental data, which is we are able to observe preferences on both sides of the market. And then we can do various counterfactuals, but the long story short here is that it's not as easy to sort of like move it, like have policy experiments such as forcing the government money to go to the best performing GPs, because if we do care only about returns, sure, that could be a way, of course, to like increase overall returns of the typical GPs in the market. But the various, like in equilibrium, this also means that there is substitution, and also that in terms of welfare, we do see that government GPs will lose a lot more than what the non-government GPs would gain by allocating more government capital to the private entities. And of course, if we think the government-owned GPs play a role for society about increasing, for example, like leading to like positive externalities and so on and so forth, which we're not taking a stand of, that's something to evaluate. And we are still working on the counterfactual, just to give you a sense that this is all still very much work in progress. But I'm running a little bit late. So this is pretty much the conclusion, which is we know the government plays a massive role. We think that understanding the demand for government participation is important. We gave you an example of like GPs getting money from government investors. This is an example that is very relevant today. Think about all the discussion with Didi and other like tech firms that are now discussing why the government is playing a role in this context or not. But if you think about the industrial policy or like subsidies that you would want to give to firms, if the good firms do not want to get money from you, from the government, that's going to have implications when it comes to the distributional consequences of this type of policies. And so there is a lot more that we're thinking about and trying to do. So thanks a lot for the time, and looking forward to Sabrina and many other people's comments. Thanks.
So thank you for having me. It's wonderful to discuss this paper by three colleagues that I really like and admire. In particular, it's great to see Bo Li, who I've known for a long time. Okay, so you know, as you all know, China's VC market has grown rapidly, and today is actually larger, by some measures than that in the US. Even in 2016, the fundraising, which is really kind of what this paper is about in terms of the relationship between the general partners and the limited partners, was already on par with the US. So what the authors are studying is quite important. Within this market, as in many Chinese markets, the government plays a large role, and this has captured, some interest in the media. For example, in this Economist article, thinking about how the Chinese state pumping funds into private equity, and it's potentially not a good thing. It sounds too good to be true for private investors. So the context here for China is there's just a couple of points that I want to make, which Emanuele also made. First, unlike in the US, it's a little bit hard to distinguish between venture capital and private equity. So here we sort of think of them both together, and they include both early stage and what in the US we often think of as growth equity investors, but not including leveraged buyout type of deals for more mature companies. The structure of the organizations follows the similar limited partnership approach for both the limited partners and then the actual venture capital firms. And so the institutions providing the funds are the limited partners, and they're called limited because in theory, at least in the US, they're legally forbidden from getting involved in day-to-day operations. That's what sort of makes them limited. And in exchange, they have limited liability, which means they can't be sued if the VC fund that they invest in, funds a biotech company that winds up killing people. So the limited partners aren't liable for that, but in exchange, they're not supposed to get involved. Instead, they're delegating this sort of selection and operational involvement to the general partners running the actual VC partnership itself. Now, in China, the government's playing a large role, as I mentioned, in this market, with actually half of limited partners being at least partially owned by the government, 60% of the market by total assets. Now, one interesting thing that the authors showed in the paper, this is at the end, but I wanted to kind of bring these descriptive statistics at the beginning, is that the government-owned GPs are actually performing worse than the private ones. And also, and this is not, I don't think, very surprising, there's sort of some matching, assortative matching on type, where the government GPs are matching to more often to the government LPs, and vice versa for the non-government GPs. So what is this paper going to do? Well, so, there's lots of studies about government involvement. They're going to ask what managers think. And they have an ambitious motivation. We study the demand for government participation in financial markets. So the bar is set high. And this is going to contribute to the literature on government participation and how it affects economic outcomes. So I'm going to kind of summarize the paper, hopefully complementing Emanuele's talk, and provide some comments and feedback as I go along. So they're going to use some pretty detailed data, mostly from zero to IPO, a prominent Chinese VC data and service provider. They collect ownership data from different sources, and they'll call GPs and LPs government owned if any of the owners are government entities. Now, one question I had is that it would be useful to know who the non-government LPs are. So in the US, the core of LPs are pension funds and university endowments. And as far as I understand, these sorts of institutional investors don't exist. And if the investors are all sort of wealthy, really wealthy individuals, that could kind of create a different dynamic in China than in the US that might be worth exploring. In particular, in terms of whether these investors are really long-term. So the top, if you have Yale's endowment as your limited partner as a VC, you can expect that if things go well, you have them for 30 plus years as an investor. If your LP is some rich person, they may want to cash out when they retire in 5 years. And so I think it'd be just useful to sort of know a little bit more about that side. So the heart of this paper is this very impressive experimental survey that they conducted with Zero to IPO. And they asked the GPs to rate LP profiles along two dimensions: how interested the GP would be in establishing an investment with the LP, if the, assuming the LP is interested, and then the likelihood that the LP is going to be interested in them. And there's sort of an incentive to report, because Zero to IPO is in theory going to use these ratings to facilitate real life matching. And so it's a nice format that I'm increasingly seeing in the experimental literature of sort of having a, what's sometimes called an IRR, or like an incentivized experiment without deception. They create profiles, and this is the key meat of the experiment, from common components that are then quantifiable and can be used in regression analysis, like the headquarters location, and most importantly, to what the paper is about, government ties. These components are randomized within the profiles, but are retaining the true probability distribution. So they'll rarely see, if something is rare in the true data, the GP will rarely see it among the 20 profiles that he gets. So this is very cool because it allows them to estimate GP preferences for a particular characteristic while holding others fixed. So my first comment is, like, let's drill down into this crucial dummy variable for government ties and ask sort of what is the variation in the experiment that is driving this. And here I think it could be useful to add some more discussion and commentary, which I think Emanuele actually did a little bit better in the presentation than is in the paper. So this is what the table looks like for the actual profile text that these GPs are seeing. And so this is very important. So they're getting one of these 11 options of text, which is what the GPs are working with. And they're going to categorize each of these as having either a 0 or a 1 for government ties. So there's a few of these 11 options that clearly indicate government provision of capital. So like here at number 11, it is funded by the local government. Okay, that's clear. Nobody's going to misinterpret this. But half of them, like, really are talking about the investment strategy of the fund, and specifically are sort of focused on the fact that they're allocating money to the private market, which just seems like, first of all, this just seems like sort of word salad fluff to me. Like, of course they're allocating money to the private market. It's a venture capital firm. Like, they're not, unless they were funding state-owned enterprises, like, this seems sort of obvious. But more importantly, there's no indication of the government of whether the LP has government ties. So here, the investment strategy relies on the private capital market and modern management practices. So maybe there's some like secret code here that a Chinese person would understand. I don't understand that this means that this fund does not have any government ties. So then there's some other ones where they say that the government approved the fund. Now, is that a tie? In what sense? So again, I may be bringing my sort of American background to bear here, but in the US, like, lots of financial entities, like banks, have to be approved by lots of regulators. But that doesn't mean, that the Fed gets to like be involved in the day-to-day operations of the bank, even though they're approving parts of its, operations. So, you obviously can't redo this experiment, but I do think you need to explain more clearly what these statements conveyed to these GP responders. Most of them are not actually stating whether the LP is government funded or not, and whether it's government managed or not. And these two things, by the way, are quite different. And they are very different from the operational strategy of, for example, promoting the private market in China, versus sort of the state-owned sector. So it just felt like the experiment wasn't really targeted to answer the research questions. And since the paper is about government ties, I think it's important to kind of spend some time on this. And then, by the way, I think it would be interesting to separately consider central and provincial ties. And I actually think that like this is going to come later in my presentation, but the fact that government ties can be useful because the local government can then help with like certain types of approvals for your portfolio company. It seems like the local government could be more useful in a concrete way for that type of operation. Okay, so moving to the experimental survey results. So they find that these GPs prefer investors with deep pockets who are headquartered in Beijing. They dislike GPs that have the government ties and that are sort of focused on certain industries. I thought it was interesting and surprising that foreign doesn't matter one way or the other. And I was curious if like that's definitely true for all subgroups, or if there are some, for example, firms that are more focused on investing in foreign companies, or who are focused in sectors maybe that have like national security elements, where they don't like, they particularly negative to have a foreign investor. So I think it'd be useful to just drill down on that a little bit more. I struggled a little bit with the magnitudes. I think it's hard with these Likert scales, but I noticed that the government ties coefficient is much smaller than the coefficient on industry information or headquarters in Beijing, and you focus so much on the government ties. Then I was sort of thinking, well, like how should I think about these economic magnitudes? Does this really matter for the GPs? Like, is this an important effect for them? And one thing you could potentially do is use the standard deviations of the Likert scale to interpret it, to interpret the coefficients. Like this is some percent of the standard deviation. My next comment on the sort of experimental results is, whether they're like, so a key finding is, that the government-owned GPs don't like they don't dislike the government LPs. And since the government-owned LPs are what is available to these government-owned GPs and what they're sort of structured and set up to use, it seems obvious that they wouldn't report disliking the government-owned LPs. And like, I think that this, to me, sort of suggested that there's a bifurcation in this market between the sort of government sector and the more private sector, which we see in other places. And I speak to this a little bit in a paper I have on joint ventures in China's auto sector, mostly looking at earlier periods. But that basically, you have, it's not clear that necessarily these GPs do get to freely choose. And one reason that I think this is an important point, is that if you look at the actual coefficients in this main table, what you see is that the GP's rating of the LP is very correlated with what they expect the LP to be interested in. And if we really thought you were isolating their demand, assuming that with absolutely no concern for what they could get in the real world or what LPs actually thought, you would expect these to be more independent, I think. And the fact that they're not independent, it suggests that it's not totally clear that like everybody really has a choice. So then my next comment on here is, is about what the experimental variation is. The authors are aiming to do two things here. The first is to randomize whether an investor is connected to government while holding fixed other characteristics. This is like, I'm 100% on board here. I think this is great work and a big contribution that we haven't seen in this literature at all, in the US or anywhere else. The second thing they're trying to do is isolate GP's preferences for investors independently of the likelihood of a match. And as I just was discussing, like this is a little bit less clear to me. I think if the GP is set up to have government involvement, he's going to focus in his ratings on selecting high quality government LPs. And that's why that text I was talking about at the beginning is so important. So he is parsing that text and trying to figure out, okay, among these profiles, which is sending the signals of who's going to be a quality LP, pretty much conditional on being a government related LP. So I think, and I think that the fact that there's real world implications that this is going to be used to actually match them makes it even more, I think even more true. so the private GPs don't like government LPs, as I mentioned. And, one question I had about this is that it wasn't clear how these results that I've now talked about private GPs not liking government LPs are related to these two hypotheses that the authors talk about, which are, that there might be benefits from government capital in the form of regulatory favors and political connections. And there might also be costs and distortions from political interference in decisions. The government-owned GPs should already have political connections, so shouldn't these benefits be more valuable to private GPs? And so should we think about the results as kind of suggesting that number one really isn't at play? So I think that's something you're kind of like you could talk about a little bit more in the paper, since you've sort of already set it all up this way. And then the final thing I want to say on this is that is a little bit bigger picture, that, in doing this profile approach, how it's written could matter. So, if profiles seem like sort of don't have actually any concrete information in them, then, a smart GP might react negatively to that, or at least there was sort of a sense I got reading some of the appendix material. The second challenge is that the profile is rated as a single object. So at the end of the day, you're having to you're having to do all this sort of, regression work to figure out which component the GP is actually responding to. And so I guess I was thinking, to address both of these problems, why didn't you just ask them directly about the components themselves? Like, do you prefer foreign LPs? And so I wasn't sure, I'm sure you have a reason why you didn't do that, but I kind of wanted to know. Now, you do it a little bit in the follow-up surveys, but where you're focusing in on the government investor advantages and disadvantages. So you don't ask generally about, do you like government LPs? But then subsequently in the second survey that doesn't have the experimental section, you do ask about, what are the advantages of government investors? And, a clear winner is this obtain local government support. And I thought this was super interesting. I thought this was just fabulous. And then a disadvantage is about investment interference. So I thought, again, I just learned a lot just reading these statistics about what's happening in this market. I actually think that this could be built out into a paper by itself, not that you should, but that it could be on, and would then fit more in the literature, which perhaps you see as a little bit more developed on how kind of some government efforts to regulate Chinese markets can backfire, which I have a paper with Will Kong on IPO suspensions that's sort of in that area. And if you were to build this out, I wonder if you can link it more to the experimental results to understand which types of GPs need which benefits or face the highest costs of government LP characteristics. So and this is, I think, quite important. How does that relate to real outcomes, to the types of technology or business models they're investing in? At the end of the day, the government is in this market in China in order to promote these sectors that are crucial for sustainable development, for national, technology development, for et cetera. And so what so is it the case? Can you kind of try to move towards that next layer of the type of firms they're actually investing in? And for example, does the, you showed this benefit of, local government support. Is that benefit really important for GPs who are investing in companies that need to build local factories? You want to build an electric vehicle battery factory, you need to have the local, official support. So that GP is really going to need those LPs. On the other hand, maybe, you're a GP who's investing in new dating, romantic dating applications, and you really don't want political interference in, who you're allowed to serve in the dating apps that you're funding or something. And so that would be really bothersome. And I think that could be kind of some interesting heterogeneity to look into. Okay, so the final thing they do, and there's just so much in this paper, the last thing is this limited partner survey. In contrast to the GPs, the LPs actually prefer GPs that do have government ties. And so you have non-government GPs don't like government LPs, but non-government LPs prefer GPs with a government LP. And so I wanted to know why. This is interesting, and I think deserves more explanation. So I'm going to skip this performance thing. I know we want to have time for questions, and I'll just conclude there, so we'll have enough time. So this is a very interesting and important paper, and I didn't even get to the structural assortative matching model, which Emanuele tells me is still very much in progress. So he didn't want to talk as much about that, but it predicts that government LPs will match with government GPs, as you might imagine. And so I think that's a whole potential another layer to the paper. I guess the sort of big picture or negative, kind of feedback that I have is it did feel a bit unfocused and scattered, which I think is feedback that I've gotten in papers when I'm just trying to do too much. Like you just have so much material here. It's very hard to put it in one, 30-something paper. And so, like the stuff I thought would be most interesting is, focusing on the heterogeneity among GPs and LPs, not just using that one dummy everywhere, but using kind of like looking at the drivers of matching and how it relates to potential real outcomes in terms of technologies that get funded, and maybe leaving some of the structural model and some of the other survey results to a different paper. So thanks very much for inviting me. This was a great paper to get to know.
Thanks a lot, Sabrina, for the very insightful and stimulating discussions. Before we open the Q&A session, let me just ask Emanuele and your co-authors if they want to have a quick response to Sabrina's comments.
Probably I'll just go like 1 minute, then we should open up just to make sure. First of all, fantastic discussions, and we'll talk more, as you know, separately, and we'll bother you with like lots of comments, but like just a couple of notes I wanted to make. One is, of course, fully agreed on the importance of, in the end, knowing what the texts say, because in the end, like what I like about the experiment is that people should think about what exactly do they do? Put yourself in their shoes. What do they do? They look at the text and they respond to that. So fully agree with that. 2 notes just for the audience to know better. The text, everything was in Chinese, right? Like, so my Chinese is not as good as I would like, meaning I don't speak. Actually, Sabrina does speak Chinese, I believe. So I don't, which means I'm not the one to explain how, but of course the translation will lose something. And so like probably like Ernest book can better translate to what exactly the text was and how the respondents looked at it. But also that the text was created in the end with like 0 to IPO, and they were hyper careful in being too direct. If you say something like this is a government linked LP, and in certain ways people would react negatively, and so they try to do a good job to be vague enough that the message of there is a government link is clear, but not too direct that would sort of like put them off a little bit. But anyways, that's to be discussed more, but point super important. Also, like just to clarify on those examples, the ones that were more vague, that did not mention government, they were the ones where the government dummy was equal to 0, of course. The ones where the government was there, which are the other options, would be the ones where something about the government was explicitly mentioned. But this was just a clarification for the audience, perhaps more so. There are only other point I want to touch on. We'll try to do everything that you mentioned and perhaps cut things. That's also true. Also magnitudes and so on and so forth. The reason why we didn't ask directly is that, of course, that's a very good point. I think that's kind of like to us, like in a sense, the pros and the cons of like this beautiful experiment, in the sense of we wanted to keep everything like real, like as if it was a real choice by a GP evaluating potential partners. If you ask directly, you might not replicate the true experience that you would want in an experiment. And if I ask directly, do you like foreign investors? Often in experiments, what you get is that the people start thinking about a lot of other things that are correlated with that. And so like having the text in the way we did it might allow to control for it. Other cons, as you mentioned, but this was just to like give a quick answer to that. I will shut up now because I think comments will be more interesting. I don't know if my co-authors want to add more. Thanks again, Sabrina, truly.
Great. Now let's open the floor to the audience. Zhiguo.
Yeah, I would like to two comments. The first one, I asked the structure of GP's existing LPs. The reason I would guess that if the GP at that moment doesn't have any government connection, they would like to get one. I assume you can easily check if that's like conditional on you don't have anything, could it do that? That's the first point. The second point that I think Sabrina mentioned it, and I think it's a very good point that I didn't, so let me just explain it out. Imagine the following, which is that, you know, the reason that these guys, these GPs are carefully reading all these profiles and fill out because they were thinking that potentially the 02 IPO will do a good service, matching service to them. But they understand that they can at the most meeting 5 people, let's say 5. They have 5 slots to fill. Then all of a sudden you need to think about the probability of a successful matching from the other side. And then on that part, I'm not sure you're soliciting preference anymore, or like a fundamental preference, which is assuming away the probability of success. This is just I think Sabrina touched a little bit on it, but I wanted to elaborate out, and I don't know if you guys thought about it.
Let me try to give a quick response. Again, you guys, Ernest, both feel free to jump in. On the first point, Hugo, yes, we do observe. We actually have a test. I don't remember if it was in the draft we sent to Sabrina, but in the slide, actually, where we also control for whether the GP had already government LPs or investors or not. And we do that to show that like our differential effects that we find between the private GPs and government GPs is basically remains identical, independent of whether they already had a government investor, and also the main effect remains there. So we use it as a robustness, we can explore a bit more, but that doesn't affect our main findings, basically. On the second point, first of all, point very well taken, as important as it gets, the way we did it. So basically that is a point that if you trust our experimental design, it's not important to the extent that the way we frame the questions about asking for preferences, and asking for expected likelihood of a match is precisely designed to shut off the potential expectation that the other party, you don't think the other party will care about giving you money. And the way we do that is that we say the following. We say first, please rate the potential partner just based on ideal quality, disregarding, and we say this explicitly, please do not think about whether they would like to give you money or not. Assume that they will, and respond based on that assumption. And that's what it stated precisely in the introduction. And 02 IPO actually called all of the respondents to explain this point. And then we asked the second question, which is, how likely do you think it is that the other party would actually want to match with you if you express interest? And then we say, do not focus on whether we also shut down any other channel, similar to the point 1. So the reason we ask the second question is that we make it even more clear. We're asking you 2 separate questions, because then us, 02 IPO and Tsinghua and our proprietary matching algorithm will put everything together, feed a machine learning model, and tell you who you should match with, based on both answers and based on your preference. Now, do they believe everything and do they understand what is in the matching algorithm? Maybe not, it's not clear, and it is a bit of a black box. But if you believe that they listen to us and to 02 IPO calling them, explaining the instructions, that is designed to shut those channels off. Now, whether that happens in practice or not, we can't say. But we did try to be as careful as we could on that front. And that's a very good point. We can touch on more later.
Okay, actually, let me ask 2 questions. The first one is related to what Sabrina and Zhiguo were asking. So I think, if you think about why those GPs actually dislike government funded LPs. So one reason related to their comments is some GPs have already built up government connections, or invested by governments. But you said that you have done this robustness check. Results are very robust, but I think it's more than a robustness check. It's actually telling us the underlying channels through which they are doing this trade-off. So it will be very useful if you can actually quantify the connection that those non-government GPs have with the government, somehow, come up with a continuous proxy, and then see if, the magnitude of this dislike actually correlates to the magnitude of the connection those non-government GPs had with the government, and that can help us to understand the underlying mechanism. So it's more than robustness check to me. And the second thing is, Sabrina said that it seems like a bifurcation, between state and non-state. So one specific channel through which you can justify this bifurcation is actually industrial policies. Your co-author Ernest Liew is an expert in that. But one possibility is government LPs are actually established to sponsor specific industrial policies. I heard a lot of things about it. So that could be one of the reasons why ex-ante you see a mismatch between GPs and the government-funded LP, and that's also a reason why they don't like. I mean, GPs do not really like government LPs, but expose. Once they manage to form a connection, they form a match. That means it could be the case that the government LPs preferences are actually in line with GPs, non-government funded GPs, and then exposed. It's a great match. For instance, if a government wants to develop chip manufacturing, and a non-government GP is specialized in doing that, and then therefore they form a match and then expose, this peer will appear to be very attractive to average investors in the market because their preferences are perfectly aligned. So that could be a kind of, this is just one of many potential stories, but that could be one thing to think about. I would like to hear your thoughts on these speculations.
Yeah, so the second part is like something, Ernest, you've been defined as the word expert by Michael, so like, I let you also jump in a little bit more. Let me first quickly address the first point, which I think is, I think it is very related to Sabrina's push on like, you guys want to do more on this heterogeneity because it can tell us something about mechanisms, and that's fully agreed. One point I have on that is that, and that's also connects to Sabrina's point, I think the fact that we do see, so to me, as Sabrina said, if we do believe that the government also adds pros, and I think it does, like maybe the cons outweigh the pros, but of course there are benefits of receiving investor like money from the government, then we would expect that it's particularly the private GPs that would want even more to establish a connection, to get a connection with the government. The government GPs might already have it. They might already have the connections. They have government owners among their entities. And so the fact that we see a negative effect on the private GPs, if anything, suggests that we might be underestimating sort of like the dislike for certain negative aspects of the government, because that's precisely where we would expect the positive effects to be even more prevalent. I would like to establish a relation with the government because I don't have it. I'm not government owned, and I would like to establish that. So that's something, anyways, that we have to think more about. Ernest, give me a breather. Do you want to address also like second point by Michael a bit in more details? You're also co-author, right. So I guess you can.
Right. So I think so. There are many different types of, as we all know, there are many different types of government involvement, even in the sense of participation on the LP side. So we are focusing on government-owned or LPs for which government has an equity stake, and the analysis shown today are excluding government-guided funds. Government-guided funds are qualitatively quite different from the government LPs in the study that we showed. And they tend to focus much more on promoting local industry, and many of which may not even conform to the idea of generating positive externality in terms of industrial policy. Maybe it's promoting local tourism, or maybe it's just attracting employment to the locality. So that's something we exclude from the study. Although the specific story that Michael mentioned has a learning flavor, where you don't really know what the restriction, what it's like to having a government investor, and you don't really know what kind of restriction will be imposed on. And to sort of investigate that, I guess Emanuele sort of partly answered that to a previous question in that the survey response, or at least GP's preference for getting money from government LPs doesn't really interact, doesn't really change much, even if we control for whether the GP already has received money from government LP in the past. So that seemed to rule out this learning story, although, as you suggested, we could look at, you know, former involvement by government on the investment side, on the LP side, try to interact it a bit more as a continuous measure. That's something we can test in.
This is a fascinating paper and a fascinating presentation and discussion. I want to thank you all. But I want to may I ask some questions in the may I ask some questions in this way. Number one, what would be the most obvious economic implication in terms of efficiency we need to pay attention to, assuming that your results are correct? Number two, I don't mean to challenge your results are not correct, but you know, just saying the results are given, then what's the economic efficiency implication? And second, following the line of Sabrina and Michael's and so on, so how may we use your established result and your data and survey results and so on and so forth to think about the heterogeneity across local versus national, province versus province, industries versus industries, to dig up more the economic efficiency or inefficiency implications? Can you shed light on this, please?
Let me try to like give a quick answer also here as well. Like Ernest, both feel free to jump in. Like thanks Bernard for the point. These are like, as you noticed maybe from my presentation, I do talk a lot, but I try to like stay silent on the things that we cannot say fully. And efficiency is one of them, in the sense that I can come up with potential implications that, however, I think are beyond the scope of the paper. One being, of course, a naive interpretation of the experimental results is that if we see that the best performing GPs in terms of like returns, let's say we only care about returns, if the best performing GPs do not sort of like government capital, if you wanted to sort of spur innovation, perhaps, then you might be tempted to say, okay, then maybe it should not be the government to provide capital, because if not, you're going to attract maybe like the lower performing entities, and that's going to have implications because we only care about returns, and if we only care about that, then this is bad. So we may want to have a lower presence of the government in the economy. But this is all something we cannot say, of course, because this is only about the returns. We don't observe many other outcomes of why certain government-owned entities might invest in certain areas and not in others. Of course, another story is that you might have an implication of maybe some of the post-investment restrictions that the government often tries to like impose, perhaps because, I mean, the typical story, that's what I was discussing with Michael before. If I have like a guest speaker in my MBA class from China, they would tell me like, yeah, I mean, you think the LPs are supposed to be passive, but sometimes with the government, the passive investor story doesn't really play out. Like they tend to have a bit more of a say. It doesn't have to be negative or not, but they do tend to be a bit more active. You might be tempted to say from our sort of like findings that the implication might be maybe you want to like have a bit less of a say, because perhaps that's going to mean that maybe you're not going to be able to target or to attract the best performing GPs. But again, all of these are like kind of like very naive interpretations of the findings and not something we can speak to. On the distributional consequences on locations and sectors, which I think is the second part, that's also something where I think, first of all, Ernest, I would like you to jump in on this. You can say a bit more. I don't think we can say much. We can potentially say much once we do a bit more analysis along the lines of what I think Michael was suggesting and Sabrina were suggesting, in terms of understanding a bit better, perhaps, which type of GPs have a higher or a lower preference for government, or this preference, or whatever it is, for government money, and whether in these regions, in these sectors, maybe we can say something else. We haven't done that enough to be able to give you an answer, but I think that's something will tell you something about distributional consequences. Ernest, I'm also like, I might be missing something, so that's a very loaded question. Please try to do it justice.
I would just mostly concur with what Emanuele said. So because what are the outcome variables we observe? We observe their survey response in terms of their preferences on attributes, in particular government ownership, but also size and other attributes. And we observe a noisy measure of performance, IRR or cumulative return, which is 0 to IPO assigned performance on the GP side. We do not observe actual output or actual performance of the firm or projects that GP actually fund. And we do not measure any externality, so we cannot evaluate social impact. So in that sense, aggregate efficiency, or from a society perspective, from a macro perspective, those are the things we cannot talk about. However, that's the part where Emanuele didn't have time to go through, and also the part that we're sort of expanding. So we are able to combine the surveyed response as well as the observed matches, feeding through a matching model in order to talk about distributional consequences using the measures we do observe. So for example, if we can run policy experiments, such as if we restrict all the government LPs to only invest in high quality or non-government-owned GPs, what would be what would happen to market participants in terms of their welfare from the distributional consequence on market participants by different government ownership or by quality? What would happen to the IRR of the average GP that actually get raise funds successfully? So using those outcomes that we can measure, we can talk about IRR, we can talk about distributional consequences of the participants, but not efficiency from a society perspective. That would be the limitation of this design.
Can I follow on another dimension of inefficiency? So Sabrina pointed out that sometimes they don't have the freedom to choose. Is there any way that you can tease out more about whether there exists constraint that people can, in economics is very often when freedom to choose and match is wonderful. But if we are constrained, then it may be a source of inefficiency. Is there any way that you can just address that question?
That's a good question, Bernard. To be honest, I think what we can do is explore a bit more, which is again also like Sabrina's point. The second question we ask about, how likely do you think it is that this partner will give you money? Because that, I think, speaks a little bit to the constraints you think you have. And so we do observe that like private GPs, they do think that it's less likely that the government-owned LP will provide them capital. And so I think exploring that a bit more and which types of like respondents of GPs think that like the other side might not be as cooperative or not, I think might speak a bit more to the constraints. Just one tiny point to make there as well. I was surprised by how I think we realized that the respondents were a lot more sort of like willing to also like share their views than we realized. So like a lot of the discussion was also with Sabrina about like, why would these people say anything bad about the government and so on and so forth? And in fact, we actually like don't think we have like too much evidence on that front. We would have observed like a lot more positive preferences for government LPs also by the government-owned GPs and so on, which we don't. And also in the qualitative surveys, people were very honest to the extent that like they were sort of like rating government on the pros and cons along various metrics. And that our respondents in those cases included both private GPs and government-owned GPs. And we need to look into the data a bit more, but like there was a lot of action on, oh, the government can do this better, or, oh no, we don't like private LPs because of this, private government LPs because of that, and so on and so forth. I think exploring a bit more those responses that are very rich in economics, less so quantitatively, I think can speak to your point, and we just haven't done enough yet, but that's a very good point.
Yeah, so thanks a lot. So I guess we have to stop here. I would like to thank everyone for participating in this fantastic webinar. Let me just hand it over to Bernie for some final remarks. Bernie?
I already said a lot. I want to say thank you to everybody. The discussions and the presentation and the paper is really great. I enjoyed this very much and I learned a lot. And I want to stimulate us to think a lot more. Thank you very much. Our next one would be on ownership network and firm growth. What do 40 million companies tell us about the Chinese economy? and it's a paper by that Chen Jun will present the paper, and Michael, you yourself would be the discussion that time. Zhiguo and Peng Jun, do you have anything that you would like to add here, please?
I don't. Thank you. Thanks, everyone.
Well, okay. Thank you, everyone.
Thanks a lot.
Yeah, thanks. And also, I want to thank the audience and the team for organizing this. This is a great seminar. Thank you to you all. Thank you. And good,
Bye.
good
Thank you,
day and good night.